Markets, they've stopped falling, but that does not mean that they'll start rising. I mean, if I look at the screen is looking slightly patchy. The comeback in the month of April has surprised everyone. Even though the verdict on the street was that we've peaked out for the year, most of the brokerages by middle of April were on one side of the boat, which is that 11,000 will act as a top for the market. We've not gone beyond 11,000 on the Nifty, but the strength in mid and small cap stocks in the month of April was very, very heartening. Crude, macro concerns, shaky, shaky outlook for PSB banks, and yet bulls have mustered a lot of strength. For the year, we are actually in the positive, and who would have thought that given where crude is, all the external factors which are at play, we would be standing where we are despite so many headwinds. Basant Maheshwari joins us to talk about value, themes, ideas, and where one should be picking bargains in this kind of a market. So Basant, bulls have gone for a long hibernation and one needs to get more realistic. Do you think that for the moment Indian markets are stuck in a range?
Good morning, Nikunj. I mean, there are two things to it. If you look at the Nifty can go up to 11,000, but that's not where money is made or lost. Money was lost in small caps and it will be recovered from the small cap index. So we talk about the Nifty, we talk about the Sensex, but the average Joe on the street is still bruising his wounds with the stocks that he bought during January or December or November last. So on a broader scale, I think we are done for the year. We are done till elections. But the Nifty can go up, but the average person on the street doesn't buy Nifty stocks. He is the oversmart guy. He is the greedy guy. He is the more self-centered guy who wants to make 100% in 6 months. So you don't make 100% in 6 months in Nifty, but he's okay losing 50% in 6 months. So that's what's happening with the small caps that he bought, and though all those Chakri and the Kachra stocks that he's bought. But I don't think there's any hope there. Obviously, the markets are back to quality. It's back to business model. It's back to balance sheet. And that's where a stock picker's mind is put to use, because when every stock goes up, nobody cares a damn about which stock is going up 40% or 30% in earnings. At that time, price becomes a determining factor. But now I think from price being the determining factor, earnings would become the determining factor. And that's great news for anybody who wants to buy good quality and wants to buy sustainable businesses. So there's no hope lost. The car should now be strong enough because roads ahead are bumpy for the companies that were devoid of earnings. That's what I feel.
Basant, the market concentration for the moment is centered around companies which are giving you decent growth visibility, whether it is Bajaj Finance, and HUL, or Titan, or Jubilant Foodworks. But whereas the market is getting polarized, and sliver of the market is where earning visibility is strong, a lot of money which is coming via the SIP route or via the HNI route is chasing very few stocks, because all those Bhangar caps and Chakri stocks have come down, and I guess a lot of investors have burned their finger when they try to act cheeky. So my question to you is that, do you think the risk for investors now, at least in buying quality stocks, is actually valuations?
Nikunj, we've discussed this before also. I think growth acts as a painkiller to the pain of valuations. So if the valuations are high and if there is growth, you don't feel the pain. It's the, you could say, the ibuprofen of the stock market. So the moment there is no growth, then there's only pain and there's trauma and there is tears. So as long as your companies are growing at 30-40%, nobody would be bothered with the valuation. Not nobody. I mean, on a broad scale, the market would be tilted towards buying those companies. But the moment growth drops from 40 to 25, new investors would rush in and say, "Arey, 25% to bhadi raha hai." But no, the market would behave quite irrationally with those companies where the growth drops. So that's the time where you have to know that you are buying these companies for a certain set of assumptions, which is growth and sustainable businesses and all that big management talk that we keep doing. But you have to be very nimble-footed with these kind of companies. And as long as you're sure of the growth, then the party carries on, and you should just sit back and just focus on whether the company is growing or not. So again, the problem now happens is that you can't have 7 themes and 700 stocks growing at 25-30% in the market. So in a market, you will always have 1 or 2 or 3 themes. So people say, "Bhai, kuch naya batao, koi naya sector batao." How can you get 5 different sectors in one bull market? It's never happened in the economic history of the global world. You always have 1, 2 or 3 sectors. So I think that's what's happening. financiers, the private financiers, and the consumer space. Those are the two sectors that are doing well. And in between, you will have those IT stocks doing well just because the dollar has appreciated and just because the pound sterling has weakened against the yen and all that. But then if you're playing for a company on the basis of foreign exchange movements, why don't you go and bet in the forex market? Why buy a company and have a double derivative and a third derivative of a certain thesis that you have created?
Fair point. And within, private financiers as well as the consumption theme, Basant, one is increasingly seeing the trend wherein better is becoming the best and the laggards are remaining laggards, be it the auto space, be it the private financiers, or even IT for that matter. You're seeing the leadership remain concentrated at one end of the curve. Do you think this trend will remain, wherein the best of the leaders will continue to demand lofty, valuations because you got to pay a price in top dollar for the best?
The poor cousin theory doesn't work in today's environment. Over the last 20 years, for example, when we started the internet, I remember we used to go to Yahoo search and Alta Vista and all that, but then Google captured 80% of the market. So when we wanted to make new friends and connect with the old ones, we had to Orkut and all of them. But suddenly Facebook came in and it captured the entire market. So when you wanted to buy a phone, you had 25 different options. But today, if you want to buy a phone, either you have the Apple or you have the Samsung. And of course, there are smaller brands which will always do well. So in an environment where scale leads to a lower cost in production, in such a setup, it becomes economically unviable for a new entrant with a smaller scale of operation to actually go and challenge the existing incumbent leader in the business. For example, I read somewhere that once you have digitization and once you have loans which would be sanctioned over a mobile phone, because you have a tab and you put in your details and tuck, you go on it. The break-even point for a new loan comes at 5,000 rupees. It was 20,000 earlier. So this is the bottom of the pyramid for the urban India. So these kind of things. So who can come and challenge companies who have got scale, and scale helps them to lower the cost of production. So even in the West, if you see all those fancy names, not the fancy names, the much talked about, the Facebooks and the Apples and the Amazons and the Netflix and the Googles of the world, they are growing at 20, 30% at that kind of a market cap, $800 billion, $900 billion. So if you have companies growing at 25, 30, 40% at that kind of a market cap, and they are capturing the entire world, I think there are just two ways to do it. Either you can sit back and say, no, someday it's going to burst. And if you are consistent, someday you'll be right. But before that, you would have made enough.
Indeed. So the favorite question that I'm sure you're asked all the time, any newer hunting grounds or just stick to the same, buy more of the same on dips? Is that the strategy to follow in this market?
Actually, the hunting grounds change with respect to the stocks. The sectors remain the same because, as I said, the theme doesn't change. So obviously, the theme took a backseat when the PSU recap started in October, and that time we were scratching our heads 7 times a day rather than 7 times in a year, trying to understand what's gone wrong. Why are companies which are reporting earnings at 30-35% not moving? But the moment you saw this PSU bank problem come up again, whether it was a Nirav Modi or whatever, the PSU guys have gone back to loan recovery, then to be giving new loans. I think about a couple of months back, Uday Kotak made a very interesting statement. He said the ratio between private and public goes to 50-50 over the next 5 years. And if it's coming from Uday Kotak, one has to sit back and think a lot more on that. So if you do basic high school algebra on that, if it's 70-30 right now, and if the nominal growth, credit growth is 15%, little more than the GDP growth, and if it goes to 50-50 in 5 years, it implies, in short, that the private financiers should normally grow at 27% CAGR. That's just too much for a sector. So you can have companies that would grow at 22, 23, or you will have companies that would grow at 35, and you would have new entrants into this space. So when a sector is growing at 25%, you want to be with the best, you want to be with the ones who can manage risk, and you want to be with the ones who can scale up. So if you get all three in a single sector, then obviously you change horses, because the old horses become weak, and then you say this guy can't run too much. So then you go and buy a new horse, or you bet more on the existing horses. So you can change the horse, but the track remains the same.
Fair point. Basant, great to always gather your wisdom on the markets and, of course, investment strategy and psychology behind it. Good speaking with you.